afternoon and welcome. Thank you all for coming to hear me talk about overseas properties, which is what I specialise in. Today specifically, I'm going to concentrate on the emerging markets. That's not a market that I concentrate on in the business world, but it's one that I get asked about by a lot of investors, and I'm sure you all do too. You only have to open the newspapers or click onto PropertyGuru and see the amount of emerging markets that are appearing in our advertising and the number of developments that are coming over here to sell to our Singapore investors. So just a quick summary of what I'm going to be talking about today. First of all, I'm going to look at what can be considered as emerging markets and why they are so popular, particularly to the Singapore investors. Perhaps looking a bit at the local market and why that might not be performing and why looking at alternative options is becoming more and more popular. Looking at some of the statistics and data on the emerging markets and how you can use that to close deals and generate fees and revenues for yourself. And also, if you are looking at those established markets, the UK, Australia, Japan, is it all doom and gloom, or is there still a market for them in Singapore as well? So first of all, what can be considered an emerging market? Well, when I was at school and studying geography, they used to be called less developed countries, and that wasn't considered very politically correct. It then became less economically developed countries, and now it's been retermed to emerging markets. And it really is just looking at that per capita income, and it's that low and middle range. They're also transitional. There's a lot of change going on in these markets. They're moving from a closed economy to a more open economy. They're embarking on a lot of reform, both in terms of the economy and in the exchange rate. And they're characterized by a lot of local and foreign investment coming in to the economy. So the emerging markets constitute about 80% of the world's population and about 20% of the world's economy. So they're very, very important in terms of what's going on globally. So why are emerging markets popular areas for investment? Well, first and foremost, everyone who lives in Singapore knows that Singaporeans love a bargain, and they are very affordable. And that's become increasingly more important in Singapore since rules and regulations have been changing in terms of financing. Obviously, TDSR and things are restricting financing options for investors. So emerging markets do give you that option to buy with cash. It's obviously a much lower quantum. And I guess, people who own property in Singapore who might not be able to sell it, can't refinance, releasing capital to invest elsewhere. So the fact that they're affordable is a very huge attractive plus point for these options. Secondly, looking at the economic reform program, which I mentioned earlier, that's going to just lead to a much stronger and more responsible economic performance levels, and it's going to become a much more transparent and efficient economy. So it's going to put a lot more trust into the investors that are looking into these emerging markets. The same with the exchange rate reform. It's going to lead to a more stable local currency, which builds confidence again in the local economy. And that's especially important to those foreigners who are looking at essentially buying into that local currency. As I also mentioned, there's a lot of both local and foreign investment. That's coming from places such as the World Bank, the International Monetary Fund, as well as a lot of companies, private sector companies, who are investing into these emerging markets because they see the potential. And because these markets are in this transitional period, they're not stable, and that does mean that there is some risk involved. And if you speak to some investors who are looking at their portfolios and at their options, there are those that are looking to diversify their portfolio, and having some element of risk is actually quite appealing to a lot of investors, and that's another thing going for these markets. So this strong domestic and export-led growth, along with this growing working population, is boosting manufacturing, it's boosting office and residential property markets in these emerging markets. The population is becoming a lot more urban, so there's a lot of growth, population increases in these cities, a lot of construction, and a lot of potential to make money in that sector. So what are the disadvantages and advantages of investing in these emerging markets? Well, let's start first on the disadvantages so we can end on a high point. Well, they can have unfamiliar and unregulated laws, as we all know. There can be language and translation issues. Not all of them speak English as a first language like we do here. And it can make it very difficult to understand the legal implications of the contracts you're getting involved in, to understand the full implications of exactly the security of the investment that you're making there. The markets are still very volatile. That's an advantage and a disadvantage, but they're very unproven markets, and they're very unknown in terms of their trends. They could go anywhere, and there isn't really the research behind it to prove that the market's going to go in one direction or another. So, as I mentioned, it is a risk. There's that transparency risk as well, in terms of, a lot of these countries don't have proper property titles. They don't have a land registry. So today you might own it, and tomorrow that piece of paper might mean nothing. And there's the corruption risks as well. There's the threats of bribery, unethical business practice, things that we take for granted in Singapore, but things that can happen in these emerging markets every day. And then lastly, I put currency exposure. It can be at an advantage and a disadvantage. It came up in the first talk as well. You might lose money on your property, but be making money at the same time in terms of the currency exposure. So it's something you've definitely got to take into consideration. But if we look at the advantages and we look at why these investors are looking into these emerging markets, and why increasingly many of your companies are asking you to consider selling projects in these markets, it's really down to the opportunity. They offer a massive amount of potential in terms of what you could make. They're affordable, as I mentioned earlier. They are high risk, but with that high risk you can or could be rewarded with high return. They offer diversification, which I've mentioned already. A lot of these emerging markets are in Southeast Asia. They're close to us geographically. They're our neighbours, so they're easy to get to. They're places that many of us are familiar with from travelling, both for personal and business reasons, which does make it easier. If you're in the same time zone and things, it makes it a lot easier to talk to your agent, talk to your brokers, talk to your tenants, and we can't take that for granted. And again, ending on that currency exposure, which can make you money at the end there. So which emerging markets should you consider? Well, on the left-hand side, I've listed there the 10 most efficient and transparent markets globally. And as you'll see, Africa really dominates those first position top spots within the list. And Indonesia, the only one that appearing in the top 10 at number 5. So I've then really looked at what the regional emerging markets are and how they're ranked. And you can see them listed there. I think Singaporeans, when they're looking at emerging markets, and we'll come on to this later when we look at exactly where the projects that are being marketed here are, they are all within the region with the exception of Brazil. And that really demonstrates, I guess, where the demand is in terms of the Singapore investors and where they're looking at. And I'll come on the next slide here. We'll show you exactly how they've gone about ranking these different emerging markets. So Indonesia ranked highest within the region. This is actually taken from a survey that was done looking specifically at commercial property rather than residential property, but there's a lot of aspects of it which can be taken across to the residential side. They're really ranked in terms of transparency, ease of owning property, ease of leasing property, speed of lease transactions, and level of bureaucracy. It's quite difficult probably to read it from where you are there, but really what it gives you is an indication, and I guess investors can look at this and decide what's important to them in terms of an investment. To some people, transparency and the fact that there's no argument in terms of what they they own and the property title might be more important to how quickly they lease a property, whereas void periods for some investors might be ranked higher. So I guess this gives you the option to look exactly which countries rank well in different sectors. So again, looking at the emerging markets that you can consider, and this was coming back to my point in terms of looking at them regionally. This looks at the Singapore exhibitions held for emerging market residential developments. It's taken it's CBRE research, but it's looking at press coverage for exhibitions that are launched here. And really what it reflects is exactly where the demand is, because going on the basis that if a developer's coming here, then they're getting sales results and they're coming back here. So Malaysia, you can see, obviously, is the highest marketed location in terms of emerging markets in Singapore. It's come back a bit since 2013, but it still sort of dominates the overseas marketing on the emerging side. Second, obviously, is Thailand, which is looking fairly consistent. And the new entrant to this year would be Cambodia, which has gone basically from nothing in the last 2 or 3 years to over about 10 in the first half of this year. The one that's perhaps missing from this slide is Vietnam, and I know there have been a lot of schemes coming from Vietnam. Oddly, they haven't appeared in the first half of this year, but I have seen some in the last month, and I know some appeared last year as well, so that would be one that would probably need to be included in here as well. And as I mentioned, the only one that's outside of the region is Brazil, an emerging market which globally is recognized as having a huge amount of potential. The reason, I guess, why it doesn't come to Singapore as often is, one, down to geography, the fact it is just so far away. Two, probably a lot down to language, and three, familiarity. I think we can't discount that in terms of, the amount of people who would have gone to Brazil for any reason is probably very minimum, and that makes it a very difficult starting point in order to consider for investment. So looking at some key stats on these emerging markets, you can see, I guess, that first point, the buying price per square foot. That's based on a 1,300 square foot apartment in prime central cities within these countries. It's not very accurate, but it gives you some idea of comparison between them all. And affordability is reflected once again if you compare that to that Singapore I've listed at the bottom there. They really, really are a very, very cheap option. Gross rental yields are again much higher than what you'll achieve in Singapore. That can really appeal to a lot of investors. It's certainly a lot more than you get with your money sitting in a bank here. Indonesia scoring the highest at 9%. Rental income, there's a huge range in terms of rental income. It just has to be something that, as an investor, you're aware of exactly what your outgoings are, so you can work out exactly what your net yield is going to be. Transaction costs are looking at both your acquisition costs and your disposable costs, merging them together. Most of them quite comparable with Singapore, a few of them coming in a bit cheaper. Capital gains tax, again, a bit of a range going there. And finally, the buy-to-let income ratio, all outperforming Singapore. And so you can really see why there are statistics that are circulating which are making an investment into the emerging markets a very appealing proposition to a lot of people who are cash rich. So then very quickly, and I'm not going to pretend to be an expert on all of these markets by any stretch of the imagination, but just going through some of those options in the emerging markets and why they might be appealing and what the house price index are doing in the area. So in Malaysia, I guess you can see from the graph there that very steady growth, but that's not always what investors are looking for. Sometimes they're looking to make a fast buck, and Malaysia perhaps isn't necessarily the market for them, but it is showing a slow, steady growth, and that that tends to be a more consistent growth, which is going to appeal perhaps to the more risk-adverse investors out there. So the key selling points, and I guess why the most developments out of any location come to Singapore, they're obviously our neighbours. It makes it very easy to get to. There's the new high-speed rail link coming in. If you're looking at emerging markets, infrastructure and investment into infrastructure is a massive key into what's happening in the economy and how much income and investment is being made from outside parties. So something like a high-speed rail link is a massive key indicator. It's been ranked 6th most easiest and friendliest country to do business with by the World Bank. So therefore, there are lots of multinational companies presumably going into KL, into Malaysia, investing money, employing people, all helping to improve the economy, which can only be a good thing for residential property prices. And then you look at the disadvantages, and you've got to make the balance between the two, and if one outweighs the other, or how much weight you put on each advantage or disadvantage. And obviously there is political tension there, ethnic strife. There are government attempts to make housing more affordable, and this has led to a lot of oversupply or perceived oversupply. And then you look at the hotspots. Kuala Lumpur has been identified as one of the 30th most important cities globally from high net worth individuals as of this year. 4th highest in the region after Hong Kong, Singapore and Jakarta. So that's a pretty good accolade and high accolade for Kuala Lumpur, and a pretty big selling point to invest into there. And then if we go on to Thailand, again, you can see the house price index increasing. It's a little bit more volatile than it is in Malaysia, but Bangkok's condo index was up 14% in the first half of this year. So a pretty positive result. Is it sustainable? I don't know. That's pretty strong growth, but it's certainly a healthy story. And the key selling points: land prices have risen every year since 2000. There's a doubling population. Where you've got those population increases, that's indicating a huge amount of demand. And if supply is not meeting that demand, then that can only mean one thing, and that's the property prices to go up. Again, you've got that infrastructure investment into the MRT and the new BTS train systems. It's at least 4 times cheaper than Singapore, coming back to the affordability, and strong economical fundamentals, which again give good prospects for capital gains. Disadvantages: you've got the political unrest, the economic slowdown, and the consumer confidence has taken a fall so far this year. But again, looking at the hotspots, Bangkok is probably the most obvious in terms of locations within Thailand looking at to invest in. The condo market, as that house price index has indicated, is very healthy. It's a very similar model to the Singapore market in terms of the product that they're delivering and the developers that are working there. So that would be where you'd look, I guess, if you were looking at Thailand, and that's certainly the locations which are launched in Singapore where they tend to be. Cambodia, unfortunately, no house price index. They're a bit slow off the mark in terms of collecting that sort of data as of yet, but there's no doubt that it is changing. We can see that from the fact that Cambodia, has gone from marketing nothing in Singapore to 9 so far this year. I know a lot of you have had a lot of success with the developments that you've launched so far this year. CBRE have been involved in a couple which have sold very well. So the property market is recovering. It's gone from a period of being quite depressed and having quite static growth to showing just that start of the property prices tilting and going upwards. Phnom Penh land prices rose an average of 15% in 2013. No figures yet of last year. As I said, they're still sort of a little bit slow coming through with tracking those results that they're achieving, but they're all looking pretty positive, and it feels like it's just at the beginning of that growth period, which is really at the stage you want to be considering investing into these markets. House loans are up, which is indicating there's more money circulating in the economy. There are people that can actually afford to invest into property now that might not have before. Again, all a good point. So the key selling points: strong economic growth. They've introduced ability for foreigners to now invest into Cambodia. Still not that straightforward in terms of structuring your purchase, in terms of how much and exactly what you can own, but that's all things you've got to sort of consider and make sure you're aware of when you're making these recommendations to your investors. Residential construction activities increased. There are more real estate companies out there. There's just a sign of a lot more activity going on in the market. A lot of foreign companies are moving into Cambodia. More employment, more money, all helping the economy to circulate. And local buyers are buying, which I think is always very important. You don't want to be completely reliant on overseas and foreign investors. You want the local buyers to be buying. It's particularly important when you you've got to think about your exit strategy. You know, investing into anything, you've got to think about how you're going to sell it when you come to want to sell it, whether that's 6 months, a year, 5 years, 10 years, or 20 years down the line. There's got to be someone to buy that property from you. And the chances are it's going to be a local buyer. They're the easiest to target when it comes to resale properties. So if there aren't local buyers active in the market, then that's a pretty big warning sign. Disadvantages: interest rates are high, still got a very poor population. 80% of new condo buyers are still foreign, although that's looking to change in the next 5 years. It's probably going to completely reverse, and they're predicting it's going to be up to 80% local buyers within 5 years' time. And it's still got a pretty fragile legal framework. The land registry isn't watertight, it is changing. There is the ability for foreigners to buy into Cambodia, but there's still some uncertainty with investing into that area. And again, Phnom Penh identified as perhaps the city, the hotspot to look into with Cambodia. Philippines, again, you're seeing a pretty volatile market, a big downturn in the early part of 2001 to 2003, but then quite steep increase since then. They've risen as much as 113%, which is about 34% in real terms, between 2004 and 2014, so that's pretty healthy growth for that 10-year period. In 2001, the Philippines experienced the 5th highest price rise in the world. So that's really, looking at the graph there, indicated by that very steep gradient. But despite that price growth, it still hasn't recovered from pre-1997 Asian financial crisis. So there is still some way to go in terms of real price, in terms of prices, in terms of where they could get to. In terms of the key selling points, the president, he's very keen on sort of anti-corruption and good governance campaigns. So he's definitely trying to push the country and push the government and push the country into the right direction in terms of anti-corruption. Low interest rates, increased foreign investment, one of the fastest growing economies in Asia, and that's only second to China, and high yields on those rents. So all those key indicators we looked at earlier for what you should consider in terms of emerging markets. They've all got disadvantages, and these are some listed for the Philippines. Natural disaster, it's got a very segmented market. There's definitely 3 set tiers, and they can all be doing slightly different things, and you've got to be aware of exactly which market sector your development falls within. There's an election due next year, which is always going to create some uncertainty and political instability. If there's a change in government, that can bring a whole host of different reactions to the economy and to the market, to the foreign investment. So that's something to keep an eye on. Some say that there's oversupply in the Philippines, it's argued, but as in with every market, you've got to look at that supply and demand. And the taxes are considered pretty high for the Philippines as well. And really, again, the only market to look at there is Manila, within the Philippines. And lastly, if we look at Indonesia, property market is beginning to slow. It's been pretty strong, but it's being controlled quite heavily by the government. There's a lot of cooling measures that have been introduced, such as the loan-to-value ratio has been implemented, and for first, second, and third properties that you own, that loan-to-value comes down from 60, 50, 40%. There's restricted funding for buying off plan, which is encouraging the developers perhaps to hold off. They can't get funding themselves, they can't sell off plans, so trying to restrict that supply coming onto the market. Property prices are around 10%, still pretty healthy, but definitely a slowdown on where they have been in the last few years, which is anywhere between 15 and 17% year on year. So the key selling points is really that at the moment, the only key selling point really that's been identified is that people are investing into residential property because of the high inflation levels. It offers them some protection from that front. But the disadvantages, I guess, especially we're seeing in Jakarta, is that there's a decline in expats arriving there, decline in business travel. So the economy is really starting to slow down. There are climbing vacancy rates, which is not good, obviously, for your yields if you've got apartments sitting there empty. And the market does remain pretty opaque. There's some concern about the property land titles, the process and the court systems. All unfamiliar, all not that clear, all mean that you might own a property or think you own a property today and it's gone tomorrow. Hotspots that have been identified, Jakarta being the obvious one. It's where most multinationals have their headquarters. And then if you look at a slightly different market, the Gili Isles, which is more of a second home luxury or tourist destination, it's being considered as very affordable compared to the likes of Bali, which are next door. It's got improving infrastructure going in there, new airport, new direct flights and things from Lombok to Singapore. So again, two options there, both quite different proposals in terms of what you might put to your investors, but both things to consider. So what are the golden rules of investing in emerging markets? Well, this is advice that I'd give to you and I'd tell you to give to your investors as well. And a lot of these rules apply to emerging markets and established markets. Buy an appreciating market in the early or mid stages of growth. Just as you're seeing that rise in the property prices, that's obviously where you're going to see the most capital appreciation potential going forward. Secondly, and I think probably most important in the emerging markets, is buying from a developer with a very strong record, who's financially stable. There are too many horror stories out there in the press about developers going bust, deposits being lost, and I guess that's something that can happen, is more of a risk in the emerging markets. It's more difficult to chase down those developers or to chase down, I guess more importantly, your client's money. The great thing is that there's a lot of these big international developers, a lot of Singaporean investors are seeing opportunities in these emerging markets, and they're going there. And with their names behind them, it makes the Singaporean investors more confident to invest in those locations. So if they're familiar with the Singapore developer, they're more likely to invest in it wherever they're investing in the world, whichever market they're going into. The next two comes down to every market, really, just looking at the supply and the demand. You want limited supply and you want a lot of demand, and that's going to help push the property prices up. So in any area, in any market that you're looking at or considering looking at, just see if you can get some idea, and it's pretty easy statistics to get hold of. Look at what that supply pipeline is going forward, and most of them have a pretty detailed idea for the next 5-10 years of exactly what's coming onto the market. It's pretty well documented through planning systems and things. And demand, I guess, really comes down to population growth, and that's both natural population growth and migration from people moving in and out of these cities. Fifthly, buy into a liquid market with a large volume of transactions. Again, I couldn't stress this importance more. You want there to be a lot of buying and selling going on. It indicates there's activity in the market. It indicates there's money circulating in the economy. It's ultimately giving people jobs. It's giving solicitors, agents, mortgage providers. They're all benefiting from a lot of transactions. It's all an indicator that there's money in the system. It's a well-oiled engine. And when you come to sell that property, your exit strategy is a little bit clearer than it might be otherwise. And lastly, get advice from a local. Don't always trust as an investor, don't always trust what you're hearing from a Singapore broker, I guess you'd say. Hear what the locals want, hear what they're renting, hear what they're buying. It doesn't, with the internet nowadays, it doesn't take a lot of expertise to get on there and just read some forums, understand what the sentiment is in the market, understand what drives people to sell, to rent, to buy, to hold, to sell. And as Benjamin Franklin says there, an investment in knowledge pays the best interest. Just do as much research as you possibly can on these markets. They're huge, they're complicated, but the more you know, the easier the sell will be, in a way. I guess when you're talking to investors, don't be afraid to tell them the advantages and the disadvantages. As brokers, we're all making money from repeat business, from referrals, and we shouldn't think about the quick buck in terms of flogging 20 apartments on a weekend in some emerging market that no one's ever heard of, and they'll lose their money, because we all know it's a pretty short-lived game if we play it that way. We've got to go in with a far more considered approach, I think, and a long-term view on our business and working, I guess, with these emerging markets. So in terms of the other options, if it's not an emerging market, it's an established market, and we all know there are plenty of options out there in Singapore to invest in established markets. It's what I do, it's what I concentrate on more so than emerging markets. This shows you here the breakdown of what's marketed in Singapore in terms of both established and emerging markets. And as you can see on the left-hand side, the established markets, there are a lot more developments that come out here from the established markets than there are from the emerging markets. It is slightly changing, but it's still very, very important part of the overseas marketing in Singapore is from these established markets. So we're looking at Melbourne, London, and Japan being the top 3 most marketed locations within Singapore for investments. So I guess a bit about why I do that, and I concentrate on the established markets rather than the emerging markets. As you can see, I haven't counted them, but there are over 20 different countries or centres listed there. You can't possibly be an expert on all markets, and I think it's important to try not to be. They've all got different political, legal, financial implications to investing in there. And I guess that I've taken the view that to concentrate on a few, to be a master of a few markets rather than a jack of all of them. Singaporeans have been investing in the established market for many, many years. I guess London predominantly, but Melbourne's taken over more recently. And the reason, people quite often ask the reason why all these developers come out here to sell them here, and often they come out here first before they're offered in the local market. And really the reason behind that is because the Singapore market is so familiar with buying off plan. It's how you buy here. Singapore investors can look at a floor plan and they can visualize that space. They can visualize exactly the room layout and even the views from certain floors. In the UK and in Australia, they're not that familiar with buying off plan, and certainly nothing with a very long-term view in terms of completion. If they're buying 2, 3 or 4 years away from completion, they don't sort of have the foresight to think, I guess, that far ahead. But these developers, they still need their funding, their financing, and a lot of that comes from selling off plan. So that's one reason they'll come out to Singapore. And the centres, I guess, that come out here, that are advertised here, and I guess would indicate that they sell well here, are really centres and cities that Singaporeans are very familiar with. That definitely makes it an easier sell for me. If someone walks into my exhibition and says that they've lived in London or studied in Melbourne or have children going to Sydney University, that's half the battle. It's definitely a much harder sell if they've never been to the country. And so these are all cities, I guess, that a lot of Singaporeans have spent time in. They know, they understand, and that makes it a much easier investment, they're more familiar with it. So is it all doom and gloom? Well, I don't think so for the established markets. Predictions in terms of growth are still very healthy. I'll come on to a slide later that'll show you exactly where I think a lot of them sit in terms of the property cycle. Established markets are a lot easier to predict in terms of where they're going. Not only, I guess, are the supply and the demand a little bit better sort of tracked, I guess you'd say, than in the emerging markets, but also they're just a little bit more predictable in what they do. And the statistics in terms of what they've done have been recorded a lot further back, so you can start to see those trends of what happens when and what things impact them in terms of growth or fall. So that just really shows you the breakdown between emerging markets and existing markets in terms of what's being marketed here, which would indicate what's selling here, although not necessarily. And you can see that the existing markets is still greatly outweighs the emerging markets. So although we're seeing more and more emerging markets coming to Singapore, it's still someone who's big into numbers would think that looks like a pretty good buy. Well, I guess this just highlights the importance of looking at things other than statistics and how I guess these can skewer one's opinion of a market. So to come back and concentrate on what else you should be looking at, and there are points I've raised already, but the supply and the demand are going to impact those different markets, the level of transactions, the investment into infrastructure, the state of the economy and the state of the currency in those markets, and the political stability, for instance, any election due. If we look at the UK market this year, transaction levels have come way down, and one of the reasons behind that is that there was a general election earlier in the year that caused some uncertainty in terms of the direction that the market was going to head, in terms of taxes that may or may not have been introduced to certain sectors of the market, and it just holds those investors back from committing to making a decision on whether to invest or not. So it is important to look ahead, look at things like when elections are scheduled to happen, because that will, in the short term, impact the market, and if there's a change in government, in the long term possibly as well. So this was the market that I was referring to. This is the sort of graph I was referring to earlier, which shows how an established property market works. And I've indicated, and you might not all agree with me, where the different centres lie within that property circle. The good news is, I guess, is that they're all on the left-hand side, which would indicate stages of growth, but where they are on that circle would indicate how much more growth they might or might not have left in them. I guess what's important to point out is, if we take Sydney, for example, which is considered a booming market at the moment, as probably, if I was to be fair, is London, they are probably at the height of their, a lot of people are saying that the price levels are sort of at their peak. That's difficult. It's difficult to know whether they are or not. There are a number of key indicators which would indicate they've still got some way to go. That mainly comes down to looking at supply and demand in both markets, supply is very, very limited. Geographically, they're very restrained in terms of land that becomes available. They've all got very, very restrictive planning systems which control the amount of new development coming through. They're both cities that track their supply very carefully, and they know going forward in the next 5, 10, 20 years exactly what is coming on to the market. Likewise with their population, they know what the demand's going to be as well. So that area of boom market, although it might indicate that they were at the peak of where they're going to get in terms of price, they could be there for quite a lot longer, and they could still have some way to go in terms of price growth. So they're definitely not markets that should be discounted on the terms of where their price point is at the moment. If we look at London, all the research that's coming out is indicating that the price growth is going to become steadier, which is a good thing. Last year it was double digits, and that was unsustainable. So it's now looking like it's sort of 5 to 8% per year for the next 5 years. So a healthy 25 to 30%, which by anyone's standard is a good return on investment. Obviously, these established markets have all got a lot of other things going for them, which I will come on to later when looking at the advantages of investing in established markets. But effectively, they're all the opposite of the emerging markets. It's very stable. It's considered a safe haven, a place, somewhere to have your money. And that's why I think they'll continue to be seen as very attractive propositions to Singaporean investors, particularly those ones that are risk adverse. They're a safe bet. They make you sleep easier at night, knowing that I guess you're not going to wake up tomorrow and realize you have no property left. Looking at some of those other centres, I was speaking earlier to some people who are exhibiting outside, and I guess London has always been the most popular location within the UK to exhibit projects out here, but actually due to the high price point and affordability issues with Singaporean investors because of TDSR and releasing finance from existing holdings, affordability comes into it in the established markets as well. So you start to look at other cities within the UK which might offer potential for future capital appreciation. So you're looking at the big university cities, which again Singaporean investors might be familiar with from having studied there or having children going there, but the Cambridges, the Oxfords, the Birminghams, the Newcastles, the Edinburghs, all offering potential capital appreciation going forward. They haven't seen as much growth as London has in the last 2 years, which might indicate that there's more growth to come looking forward. And the same might be said in Australia as well. Sydney and Melbourne have been very, very heavily marketed in Singapore. A lot of people have already invested there. They might be considering diversifying their portfolio, but also looking for options of where prices aren't as high and still have the potential for that capital growth. And that's when you start looking at those other centres that I've listed here, like Brisbane, Perth, and the Gold Coast. And all those centres, increasingly I'm getting telephone calls from not only investors, but also a lot of my clients who I've been used to working with in Sydney and Melbourne who are suddenly considering these other centres. And, where the developers go first, they've got a lot of research, a lot of expertise behind them. They've obviously done their figures and worked out that that's where the potential is and the opportunities lie. So when you see them going there, that really makes you sit up as an agent and realise that that's where the opportunities are for the investors. That's obviously, hopefully, where the market's heading. And that's definitely where I think you'll see in the second half of the year a lot more opportunities in terms of projects being launched in Singapore. Sydney has dropped down to 1 or 2 in the first half of this year. I think we'll probably see 1. I know of 1 or 2 coming for the second half of the year, but a very, very high price point. And I think you'll see more and more from those Brisbane, Perth and Gold Coast markets being offered here in Singapore. So really, as I start to sort of draw conclusions and summarize, just look at the differences between the two markets, both of which I've touched upon already, but really just to wrap up things. So the emerging and the new markets, they present significant opportunities. There is higher risk, but with that higher risk, you can be rewarded with a potential higher returns than you would be getting otherwise. It offers diversification, and it offers you the potential to enter into investing into a residential market that you might not have the opportunity to in Singapore because of limited funding, because of the price point here. And then we look at the established and more mature markets. They're safer. You're going to sleep easier at night knowing that your money's in a place where effectively it can't be touched. Yes, the property prices can go up and down, but the property can't be taken away from you in quite the same way. It's a steadier growth. You have to be a bit more patient, but that doesn't mean you won't be rewarded in terms of your return on investment. It's more predictable, as I've shown in that the graph showing exactly where the market's going and how it works over years. You tend to know where it is in its cycle. You tend to also know what's happening in the economy and in the political systems, although, as I mentioned, elections can make that a little bit more unstable. And it's just very transparent, which is important. And that picture I put in at the bottom is something I often ask investors when they're trying to make the decision about whether to invest in a property, buy a property or not. And you can see that some people very much think with their heads, and those that think with their heads might make a lot more money, but those that think with their hearts, at least a little bit, will sleep easier at night, knowing that their money's a bit safer. Which is why I guess people who can look at an investment and not consider themselves at all in that investment, but just to consider it as a black and white investment, as I said, can make a lot of money. But I'm bad from that point of view. I find it very difficult to invest in property that I can't see myself living in, whether that's location, whether it's the product, whether it's the style of the building. And I know that does make me a weaker investment, but it does make me a happier investor, and I can definitely sleep better, often knowing that. So if we just look forward and start to draw things to a close. So the forecast looking forward, and these aren't my words, this is taken from a report that PwC have recently done on the emerging markets in Asia Pacific, is that investors are opting not to buy at the moment. Transaction levels are down. I think we're seeing that across the board in terms of the Singapore residential market, overseas residential markets. Sales rates definitely have fallen. They're still happening though. That's what I keep saying to my clients. They've gone from very, very high levels in 2013, 2014, and just dropped off in the last half of last year and the first half of this year. But just because they've slowed down doesn't mean that they've stopped. Investors are wary of secondary locations and assets. I guess when looking at the local market, when the local market isn't as strong and sound as it has been, that just creates a bit of uncertainty, and I guess, if your own property market isn't that healthy, then you're wary of other property markets as well. And I think that's quite true to say in terms of, maybe it's a time that investors are looking at different asset classes, and it's a time that we as agents who make money from property transactions can look at those different asset classes and compare them to property. And there's still a lot of investors out there that want to be investing in bricks and mortar, that would prefer to be able to see and touch and feel the product that the asset that they're investing in, rather than stocks and shares, which are less tangible. And emerging markets are losing some of their appeal. I'd say that probably it is true to a certain extent. We're seeing more product come here, but it's less fashionable, I guess, than it was a couple of years ago. But there are still opportunities out there. And I think that the potential US interest rate hike is going to make investors cautious. They're going to see a lot of capital flight, so money going out of their own economy into the US. And investors are increasingly willing to adopt the development risks. So that's sort of on the plus side, that they're saying that they're happy to put money into off-plan opportunities. A lot of them are having that money held in a much more secure way than they once were. You know, we've got schemes in Australia that we're launching that won't be ready for another 4 years, but you have to put 10% down and that's it, but it can sit in an interest-bearing account, generating you a 4% interest rate for 4 years, which is a lot more than you'll get in the banks here. So even if the property prices don't do much, well, the money's making money sitting in their interest-bearing trust account, and it's pretty secure sitting with the solicitor in Australia. So some positive stories, and some food for thought, hopefully, for all of you. I guess, as a parting word, what I'd say is, when talking to investors, and what I certainly try and tell people, is that if an opportunity seems too good to be true, it usually is. So don't always believe all the hype, and if there's a developer coming out here and offering everything, then there's probably something wrong with it. So be wary, go into the investment, I guess, with their eyes open. Give those investors your honest advice. You know, there are risks involved with investing in both emerging and established markets, but obviously the risks are much higher in those emerging markets that we've spoken about. But there is money to be made, and there's money to be made in both markets. I always encourage them to think like a local, because of that exit strategy, and really not to lose hope, I guess, in terms of property investment. And I've got one more slide which says any other questions. I've waffled on, I'm not sure for how long, but there is a break after this, so if anybody wanted to ask me questions, rather than asking me publicly, can ask me after this as well. But to the floor.